perhaps put off indefinitely the Security Council vote.
That's Lisa Miller in Washington. Well, let's check finance now. World share markets have been bouncing back from 14-month lows as expectations mount that policymakers will take further action to ease the Eurozone debt crisis. Stocks in Europe and the US rebounded after wild swings, but only after the European Union said it was fast-tracking the setup of a permanent rescue fund. Well, but global investors remain unconvinced and money is pouring into the perceived safe havens of the US dollar and US Treasury bonds. Well, I'm joined now by our business editor, Peter Ryan. So, Peter, we obviously saw some rebound there overnight. What do you attribute that to?
Well, we have the G20 leaders meeting in Washington at the moment, and they've been forced to come out with a fairly strong statement, which has been interpreted by the markets that there might actually be a shock and awe campaign in the makings. The G20 have said they'll take all steps necessary to restore confidence to the markets and to ensure that there's not another Lehman Brothers style shock in the works. But investors are really wondering what this shock and awe plan might be, given that all efforts recently have really failed to instill confidence in the market. But it really was, as you mentioned earlier, the comments from EU leaders that they might bring forward a stabilisation fund that would unveil a $700 billion emergency war chest that would protect the likes of Italy and Spain, which of course are the big worries in the sovereign debt crisis, and that saw stocks throughout Europe move up substantially, making up for yesterday's gains, and also the Dow Jones Industrial Average managed to scrape just over the line, up about 37 points.
Is it fair to say this is a political problem in Europe, that the leaders simply cannot get together and have some consensus on what the plan is?
That's exactly right. The view is that without certainty, investors don't know where to go. They don't know whether to have confidence in the markets. They don't know whether to have confidence in leaders. A lot of investors were unimpressed when the US Federal Reserve came out earlier this week with a fairly flimsy plan to buy securities, buy back securities. No more quantitative easing or the metaphorical printing of money, and also the US Federal Reserve was actually expected to hold a press conference after their most recent policy meeting. They failed to do that, and that was interpreted to the markets that they perhaps didn't have enough confidence to actually come out and state the strategy. But the big concern, of course, has been in Europe: no strategy, no unity, and of course the backdrop to all of this is the almost certain fact that Greece will default, and that if Greece does default, the contagion in Europe will spread to Italy and Spain, and that would really be a shock.
So you're saying there's pretty much acceptance now that Greece will default. It's a question of how that will be managed.
That's right. Markets want to see a strategy for an orderly default of Greece, not just a simple press the red button default. They want to see an orderly default, want to see a realistic view on the future of Greece as being a member of the European Union. Will it be put into a separate part of the European Union? Might it be kicked out altogether and be forced to return to the drachma so they could depreciate the currency and trade out of the crisis? There's no certainty on this at all, apart from the statements that keep coming that the World Bank, the EU and the International Monetary Fund are confident that Greece will remain a member of the EU, but really markets are not convinced.
All right, let's just look locally then. Investors are obviously still taking their cues from offshore. We've seen the markets here pretty much follow what has happened in Europe and the US. We've had Wayne Swan in the last couple of hours talking up the Australian economy yet again, saying, look, we're doing very well when you look at what's happening elsewhere comparatively, and we're pretty well placed here. So why does the Australian market continue to follow the others?
Well, despite the good fortunes of the Australian economy, and the Reserve Bank's Financial Stability Review made the point that Australian banks are relatively well placed compared to what's going on in the United States and Europe, the world still regards Australia as a risk asset. And if you keep in mind that over the last year or so, investors around the world have been able to borrow close to 0% out of the United States and Japan and invest in Australia, where we still have very high interest rates compared to the rest of the world. Now, despite the view from the Reserve Bank that interest rates aren't going anywhere at the moment, the market is still factoring in a cut in interest rates of 1.5%, and that means that, given the global volatility, the reality that there's not much more money to be made in Australia, all this money is going back to the perceived safe havens of the US dollar and US treasuries. And this is despite much of the woes in the world coming from the United States, and of course the downgrade of America by Standard & Poor's, where they lost their AAA credit rating 5 or 6 weeks ago.
And no doubt, I guess, people also been bailing out of commodities. That's got to be hurting Australia too.
Yeah, it would be hurting Australia, and there have been very big corrections for the big miners, BHP, Billiton and Rio Tinto. But just this morning, gold, which is actually an alternative safe haven, has lost around $100 an ounce overnight, and this makes for the biggest two-day loss in the price of gold since 1983. Silver is down something like 15%. Copper is down as well, and crude oil is down too. And this is all based on the view that the world is heading towards another recession.
As they say, nowhere to hide.
That's right.
Peter, thanks very much.
Okay.